What is capital structure? Capital structure refers to the specific mix of debt and equity that it uses to fund its overall operations and expansion. Ownership of firm shares and claims to future cash flows and earnings are the sources of equity capital. Retained earnings, preferred stocks, and common stock are the examples of equity, whereas bonds and loans are examples of debt. The capital structure is computed as the percentage of debt in the total capital that the company uses or as the ratio of debt to equity. The company's financial risk and profitability are influenced by the percentage of debt and equity it uses. Debt reduces the overall cost of capital and is a less expensive form of funding than stock, but using more debt exposes the company to greater financial risk. As mentioned before, capital structure is the combination of the company's or firm's long-term capital, which is equity and debt. It is simple to define the equity component of the debt-equity relationship. Retained profits in addition to a company's common and preferred stock make up equity in a capital structure. So there are three components of equity, which are common stock, preferred stock, and retained earnings. So the first one is common stock. In common stock, the common shareholders have the least amount of rights to a company's assets out of all other shareholders. The shareholders have voting rights for the company's board of directors and participate in decision on business policy. The dividends are not guaranteed and disbursed at the board of directors' option, and in the form of convertibility, it cannot be converted into a different kind of security. Furthermore, it is often more volatile due to its increased sensitivity to market circumstances and corporate performance and in market participation. The second component of equity is preferred stock. It combines the characteristics of debt and equity. It is often referred to as preference shares or preferred stock, where it is a securities that signify ownership in a corporation and have a first choice claim on the assets and profits of the business over common stock. The shares have a higher claim on assets than common stock, but they have a lower claim than bonds. Dividend payments are also given preference to preferred stockholders over common stockholders. These dividends are frequently expressed as a percentage in the issuing description and may be fixed or determined in relation to a benchmark interest rate. Moreover, preferred stockholders have fewer rights than common stockholders, typically not including the ability to vote. The next one is retained earnings. It is another component of equity, where it is the amount of net income that remains for the company after dividend payments to shareholders. A business that prioritizes growth can choose to use retained earnings to fund expansion initiatives rather than paying any dividends at all or in very little quantities. Retained earnings can be used by business for a variety of purposes, such as expanding their manufacturing capacity, recruiting additional salespeople, introducing new products, and share buybacks. The combination of equity in capital structure is debt, and an example of it is a bond. Bonds are high-security debt products that help organizations borrow money and meet their capital needs. Borrowers can obtain this type of financing from individual investors for a predetermined period of time. Bonds are known as fixed income instruments because they have historically given debt holders a fixed interest rate or coupon. It is also rather typical these days to find variable or floating interest rates. The relationship between interest rate and bond price is inverse, which is when rates rise, bond price decrease, and vice versa. Bonds also have a maturity date after which default occurs if the principal is not fully repaid. Next to be discussed is how to determine optimal capital structure. The optimal capital structure is estimated by calculating the debt to equity ratio that minimizes the weighted average cost of capital, which is WACC, while maximizing the market value of the company. Taking into consideration the fluctuation of the company's cash flow, the optimal structure uses adequate equity to reduce the risk of not being able to repay the debt. A firm with strong prospects would attempt to borrow money through debt financing as opposed to equity financing in order to minimize dilution and market indications of caution. Debt signaling is the practice of presenting announcements regarding a company's debt as good news. The cost of debt, preferred stock, and common stock will start to rise if a firm raises too much capital in a certain period of time. This will boost the marginal cost of capital as well. The potential equity investors look at the debt to equity ratio to determine how hazardous a company is. In order to determine if a company is utilizing an unusually high level of debt within its capital structure, it also analyzes the amount of leverage used by other companies operating in the same industry, assuming that these companies have an optimal capital structure. Applying a bank's perspective is another method to determine an optimal capital structure. What is the ideal amount of debt that a bank will lend money on? In order to assign a bond rating to the firm and create a credit profile, an analyst may also use an additional debt ratio. The spread over an AAA-rated company's risk-free rate may then be calculated using the default spread associated with the bond rating. Next to be explained is the theory on optimal capital structure, which is a Modigliani-Miller M&M theory. According to this theory, a company's capital structure is irrelevant in ideal markets as a company's market value is established by its earning potential and the risk of its underlying assets. Value, in the opinion of Modigliani and Miller, is unaffected by a company's investment and mode of financing. The M&M theorem proposes the two propositions, which are Proposition 1 and Proposition 2. In Proposition 1, it claims that a firm's value is unaffected by its capital structure. The method of financing used to fund the assets will not have an impact on the value of two identical enterprises. Anticipated future profits determine a company's worth. That is the case when taxes are non-existent. While in Proposition 2, financial leverage lowers WACC and increases a company's worth. That's the time when the tax data becomes accessible. Even though the Modigliani-Miller theorem is studied in finance, actual business must deal with inefficient markets, taxes, credit risk, and transaction expenses. For this reason, the balance between debt and equity financing is crucial.
Now, I will discuss about factors that affect capital structure decision. Firstly, business risk. Debt financing has advantages as a source of finance, such as lower fundraising costs and a fixed return on investment for lenders. But it grows riskier as business risk rises. Debt gets riskier if a corporation is in a speculative industry or has higher business risk. Companies with high business risk will minimize debt funding to mitigate the risk. Equity financing may be safer than debt when a company faces new competitors or new technology contracts in industry. Other than that, tax consideration can have effect on a company's capital structure decisions. Due to interest being tax deductible in a classical tax system, debt financing is attractive and the cost of capital decreases as more debt is included in the capital structure. To put it another way, the optimal capital structure will have no equity at all. The tax shield from interest deductions effectively lowers the after-tax cost of debt. This will make debts a more attractive financing option compared to equity, especially when interest rates are relatively low. The purpose is to maximize firm value by minimize the total cost of capital, include the debt and equity. Then, the company tax rate can change how tax issues affect capital structure. When compared to other regions or other countries with higher corporate tax rates, the tax shield provided by interest deduction is significantly more beneficial, which in turn makes debt financing more appealing. Companies may need to evaluate their capital structure when tax rates change. Furthermore, management style. Managers who have a style that is more risk-taking or aggressive may be more willing to take on larger amounts of debt in order to finance projects or expansions that have potential to greater earnings. They may place a high priority on using financial leverage to increase profits and are willing to take the risk that involved with the approach. On the other hand, conservative management style might choose a more cautious approach, avoiding excessive financial leverage as a means of risk mitigation. Even if it means sacrificing some potential returns, they may place a higher priority on maintaining a debt-to-equity ratio that is lower in order to assure greater financial stability. For a long-term oriented management style, the firm who has a focus on the company's performance over a longer period of time may be more open to the idea of using equity financing in order to reduce the stress caused by the obligation of making short-term interest payments. For short-term oriented management style, firm may be more likely to employ debt to achieve immediate financial goals as the expenses related to debt may be lower in the short run. This is because short-term managers tend to focus on the present rather than the future. Last but not least, market condition. foreign investors are ready and willing to put more money into the market, business will be able to get more money and cost of debt will be lower, which make it easier to budget for interest payments and could even increase the tax advantage associated with debt. On the other hand, if buyers are too hesitant about lending money, the cost of debt will be high. This might make it harder for the company to use debt in its capital structure. When a company decides on its capital structure, the cost of debt is very important. Next, I'm going to discuss about what is financial distress. In corporate finance, financial distress refers to any situations in which a business or individual is unable to meet their basic financial obligations, including loan repayments owed to creditors due to their financial condition. In the end, bankruptcy may be the only way out of severe, long-lasting financial difficulties. Financial problems often get worse if they are not fixed quickly. For example, a person or business that is having trouble with money may see their credit rating drop. Lenders will charge them with higher interest rate, which will make it hard for them to borrow money to get through a time when they were not making as much money. So, there are many potential causes of financial distress that faced by a company. Firstly, poor economy. Poor economy can be reduced revenue, which business may see a drop in revenue as consumers reduce their spending and demand during recession. Other than that, increased costs. Where economic conditions are poor, this might cause prices of raw materials, labor, and other input to rise, which can put a squeeze on profit margins and contribute to financial troubles for companies. Then, instability in the economy can cause market volatility, which in turn can have effect on investment returns, asset values, and overall financial stability, which might eventually lead to financial distress for firms. Secondly, poor money management. This involves poor budgeting, a failure to collect account receivables on time, and poor accounting practices. Not only that, changes in technology, ineffective management, fraudulent activity within the organization, and poor investment planning are some of the other factors that have been highlighted as causes of financial difficulties. Then, managers at the top may borrow money to boost growth, which will cause financial instability if revenues or earnings do not rise rapidly. Thirdly, unexpected expenses. Unexpected expenses for a company can include various costs, such as equipment failure, where a company may have to pay extra money to fix or replace broken equipment. Other than that, supply or raw material price increase can cause company to overspending their money, which may impact their profits. Last but not least, unexpected rent increase also can cause a business to incur significant costs. For remedy financial distress, a company can consider several strategies and actions. Firstly, companies have the ability to minimize their costs by identifying and eliminate unnecessary costs with implementing several cost-cutting techniques. Company may close facilities or downsizing offices that is not always used to reduce rental and operational costs. Other than that, it is recommended to examine all costs carefully to identify areas where reductions can be made. This includes both fixed and variable costs. Next, the implementation of energy-saving measures and the promotion of resource conservation are both recommended. Making even small adjustments such as switching to appliances with energy efficient like eco-friendly equipment or participating in recycling initiatives can result in significant cost reductions over time. Secondly, financial restructuring. In order to ease their financial difficulty, companies might look into debt restructuring options with the objective of lowering the total amount of their debt payments, extending the duration of their payments, or negotiate better interest rates. Besides, improving speed, streamlining process, and optimize the business operation can save money and make it more profitable, which can help fix the problems that are causing it to be in financial difficulties. Thirdly, implement efficient ways for managing cash flow, such as optimize inventory levels, enhance process for account receivable and accounts payable, and continuously monitor working capital. This contributes to ensure that the company has adequate liquid assets to satisfy its short-term obligations. In addition, maintain a level of cash reserve that is adequate to meet both planned and unforeseen costs associated with business. The accumulation of cash reserve during times of strong cash flow might act as a cushion against inflation to use during financial difficulty. Companies have to realize how important it is to handle their cash flow very well and to actively deal with issues related to this so they do not get into major financial difficulties.
Next, I will discuss the integrations of tax effects and financial cost distress. When deciding on the capital structure, a company might weigh the tax advantages of debt against the potential financial cost distress associated with having a high level of debt. The term tax effect describes how tax affects a business cash flow, profitability, and financial standing. When making financial decisions, companies often take into account the tax implications of those decisions. For example, interest payments on debt are often tax deductible, which provide a tax shield and reduce the overall cost of debt. Company may also consider various tax credits and incentives available to them in their decision-making process. This can influence choices related to investment, financing, and other financial activities. Furthermore, in order to temporarily improve its cash flow, a financially troubled corporation may bargain with tax authorities to postpone the payment of tax. Moreover, financial cost distress is the expenses and losses that a business experiences when it faces financial issues such as the risk of insolvency or bankruptcy. These costs can be classified into two main categories, which are direct costs and indirect costs. Direct costs of financial distress includes expenses related to bankruptcy proceeding, legal fee, and other costs incurred during the process of resolving financial difficulties. Meanwhile, indirect costs such as a decline in the company market value, loss of customers and suppliers, and damage to the company reputation. The integrations of tax effects and financial cost distress is a crucial aspect of this decision-making process, requiring a comprehensive analysis that balances the benefit of tax consideration with the potential risks associated with financial distress. First, companies aim to optimize capital structure by balancing the tax advantages of debt with the potential financial cost distress. This involves determining the right mix of debt and equity to minimize the overall cost of capital while managing risk. Second, companies need to assess the tax benefits of investment alongside the potential financial cost distress associated with the financing choices made. This involves evaluating the risk-return profiles of investment in the context of the company's overall financial health. Next, companies must integrate tax considerations into their risk management strategy, ensuring that the benefit of risk mitigations are not overshadowed by potential adverse tax consequences or increased financial distress. Lastly, companies need to conduct thorough scenario analysis, considering the tax effects and potential financial cost distress associated with various strategic decisions. This helps in crafting a robust financial plan that aligns with the company's overall objective. Next, I will continue with adjusted cost of equity. The term adjusted cost describes the expenses a company bears as a result of issues relating to the conflicting interests of shareholder and management, as well as the knowledge asymmetry that exists between the principal and the agent. An adjusted cost of equity occurs when management makes choices that may not be in the best interest of the company and that investors believe will not raise the value of their share. The adjusted cost of equity is comprised of many essential components. First, information asymmetry between shareholder and management. It happens when managers have more access to the company's internal working and financial data, meanwhile shareholders have restricted access. Second, division risk preference. It happens when shareholders could select riskier methods, but risk-averse management might take a more cautious stance in order to preserve their job security. Lastly, principal-agent misalignment. The purpose of the shareholder is to maximize value, but managers may put their own interests first by prioritizing things like pay, benefits, and job security. Next, adjusted cost of equity also have several implications. One of the direct implications of adjusted cost is inefficient investment decisions. Short-term interests may lead managers to give priority to projects that help them achieve their short-term goals above those that increase shareholder value over the long run. Next, excessive perk and compensation. Equity investor may incur higher costs as a result of manager receiving pay that seem out of proportion to their contribution to shareholder value. Aside from that, shareholder-manager conflict. This tense relationship may show itself in proxy conflict, hostile takeover, or other measures that increase agency expenses. Lastly, ongoing agency fee may result in a drop in the market value of an organization stock. The stock may be discounted by investors as a consequence of worry regarding management and governance practice, which may lead to this erosion. Therefore, there are several approaches that can reduce the agency equity cost. First, effective corporate governance. Strong corporate governance systems such as independent boards of directors, active audit committee, and frequent shareholder meeting. Next, designing executive compensation package that balance manager objective with shareholder is one of the proactive approaches to reducing agency expenses such as stock options and restricted stock grant. Furthermore, transparency and disclosure. Reducing the possibility of opportunistic managerial actions is made possible by timely and accurate reporting which empower shareholders to make better decisions. Finally, engaged and observant shareholders can play a role in monitoring managerial conduct and lobbying for reform that align with shareholder interests. Proxy voting, shareholder resolutions, and activism can act as effective tool in holding manager accountable and advocating for changes that align with shareholder interests.
Hi, my name is Umay Sarah binti Padilla. My number metric 2023168561. I will continue the presentation from my friend where I will explain about the topic pecking order theory and also signaling hypothesis. Let me start with the pecking order theory first. The pecking order theory begins with asymmetric information applied by economists to research how decisions are made in transaction. Even though the firm and the debt issuer have asymmetric information, the corporation decision to give priority the debt over the equity is a positive indication. Return earnings are frequently those which remain the companies after all of their current year's liability have been paid in the full. Firm size, business risk, and profitability are influencing capital structure decision. Additional indicator of financial stability involve the following, which is the dividends, leverage, stock repurchase, announcement of merger and execution, tender offer announcement, spin-off announcement, and also poison pill announcement. Here are some examples of pecking order theory. First, when a business finances its own operation, it might be assumed by the general public that it is doing well. The second example is a firm management is slightly confident that earnings will be enough to satisfy the loan repayment charge if the company is financing itself through the debt. The last example is when a business issues new share of itself in order to raise equity funding, it the signal that it believes its stock is overvalued. If the company want to use this theory, there are several elements that the company should think about if the company cannot generate enough money internally. Among them are internal funding, external funding, equity, and debt. Internal funding is quite straightforward and easy. Internal funding is not the best option if the business is taking on risky project with a low objective. Next, there are two categories of external funding, which is borrowing the necessary fund or selling equity in the majority of the company ownership. In terms of equity, a corporation can always sell a portion of itself to obtain money. Last but not least is debt. Debt funding is the process which is a business raises the necessary funds through loans. This is one example to calculate the pecking order theory if the company use this theory. The question is, let's say Gen company want to raise 15 million for a capital project. The stock price of the corporation is $60.88 at the moment. For Gen's company, three alternatives are available. What would the investor have to pay for this? So here there are three options the investor can use. Let's look at the calculation one by one. This is the calculation method for each option. Each option has a different calculation method. Through these three options, investor will be able to draw conclusion about this theory. The conclusion that the company can make through these three options is that management should pay for the project primarily using retained earnings, then with equity, and then with debt. Signaling hypothesis. What is the signaling hypothesis? Signaling is the act of forming a trading position using insider knowledge. According to signal theory, managers use signal to mitigate information asymmetry. It happens when an insider share important details about a business that causes others who normally don't have insider knowledge to buy or sell the company stock. Business that truly succeed in the quality must be creative and imaginative in how they convey their advantage over competitor companies. This theory keeps company from growing the profit and benefit user by providing high quality asset and profit in financial reports. A common method to acquire market signaling is to monitor the trading and ownership position of insider in a company. Company with bright future will attempt to avoid selling their share and take advantage of any additional funding needed in other methods such as borrowing money. When using the signaling hypothesis, we already know there will be insider information. A hidden knowledge known as insider information provides investor with an advantage when trading the company stock. An outsider who has a strong connection with the company could possibly similarly be considered as insider. Usually, an executive or employee of the company is the source of insider knowledge. The action of insider trading is illegal. Insider trading occurs when a director, officer, or employee of the business establish trade or suggest to the third parties that they should place a trade using significant confidential knowledge about the business. It is suggested that it is improperly change the free market. I think that's all for me. Thank you.